Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the downward flag pattern, a powerful chart formation that can signal profitable trading opportunities in the bearish market. This pattern is crucial for traders looking to capitalize on the downtrend and make informed decisions about when to enter and exit trades. So understanding how to identify and trade the downward flag pattern can significantly enhance your trading strategy and potentially improve your profitability. So we would cover everything from recognizing the flag pattern to implementing a step-by-step trading approach. So stay tuned until the end of this video to know how effective you can use this pattern to your trading strategy. Now we start by understanding what the downward flag pattern is. And the downward flag pattern is a continuation pattern that occurs during a downtrend. It is a continuation pattern that occurs during a downtrend. It is characterized by a sharp, steep decline in price followed by a brief consolidation, usually to the upside. The consolidation is always faced towards the upside before you see a steep decline in price again. This pattern is crucial for traders to recognize as it often signals a continuation of the bearish trend, providing opportunities for profitable trade. Now, this pattern consists of two main components. First, the flagpole and the flag. The flagpole is represented by a initial sharp decline in price. When you see a sharp decline in price, this indicates the flagpole, which forms near a vertical line in the chart, and this typically is driven by a strong selling pressure and a high volume in itself. Now the flag forms and it is a period of consolidation where price moves slightly upward or slightly sideways. When price moves slightly upward or sideways, we can see price after the pole, we can see price moving slightly upward in a trending market to form its consolidation or pullback. So this is basically what the pattern is all about. Now let's look at the trading strategy using this downward flag pattern. Now that we have covered what it means and we understand how we can spot this downward flag pattern, it is time to develop a robust trading strategy. The strategy would be explained in step-by-step process. The first step would be to identify the pattern. The first crucial step in trading is identifying the downward flag pattern, which I can identify on my chart. Look for a sharp, steep decline in price, which is the pole, followed by a brief consolidation, the flag, which is usually narrow slightly upward in a channel against the prevailing downtrend. So the consolidation usually forms a channel to the upside, and we can see this from our chart. After we spot this, we can analyze our volume because the volume plays an important role in confirming the validity of the downward flag pattern. During the consolidation phase, you observe a decrease in the volume, and as you can see during this consolidation phase, there was a decrease in the volume indicator, signifying a decrease in the indicator, the volume indicator, during the flag pattern. So from this area the flag pattern started till where it ended, you can see there was a decrease in the volume. As we can see, this further strengthens our indication. Therefore, we wait for a breakout. The third step is to wait for a breakout. Patience is usually key when trading the downward flag pattern. You wait for price to break below the lower trend line of the flag. This breakout signals the potential continuation of the pattern, and it is crucial not to enter the trade prematurely as false breakouts could occur. So how do you enter? You enter the trade. The fourth step, you enter when you confirm the breakout. It's time to enter the trade by placing a sell order immediately after price breaks below the lower trend line. So when price breaks below the lower trend line, you can enter your trade at that area. You enter your selling position when price breaks below that trend line. Remember to always set your stop loss, but before that, you can also enter when price pulls back to retest a support or resistance level, or if possible, if price comes back to retest the trend line. This would have been a perfect place to also enter the trade, but it does not always come back to retest the trend line. But when price comes to retest the trend line, this would have been a good opportunity for you to join the trade setup. Remember to always set your stop loss. Place your stop loss order above the highest level of the flag, above the highest point of the flag. This is where you set your stop loss level. While you define your profit in the downtrend, you can set multiple profit targets. When your first profit target can be the minimum low, the lowest point reached before the flag formation. So you can set your stop loss, your profit target to this lowest point reached before the flag. This can be your first profit target. Then you can always go for a 1:2 or 1:3 profit target area, or we can project the length of our flag. We just need to measure the exact length of our price range. When we measure this length of our flag, we project that as our possible take profit area. So this is where we project price to use this as our take profit area. And as we can see, by God's grace, the profit target was reached in no time. So this is basically how you can analyze your chart when you spot this pattern and enter your trade accordingly. So let's see another example, and I can spot another example when I spot my flag pattern. As we can see in this area, we have spotted our flag pattern. Let's put our part 2 to make it easier for us to understand. So this is my downtrend followed to my consolidation to the upward direction before we met our breakout to that direction. So this is basically our flag pattern, our downward flag pattern. So this example, how do we capitalize on the market? We capitalize on when we draw our trend line when price is trending to the upside. Remember, I said it's not in all cases that you enter the trade at a retest of the trend line. Sometimes price do not come back to retest the trend line. So this is a perfect example. The moment price breaks out of this lower trend line, you would enter your trade. Remember, your stop loss is to be placed at the highest point of your flag pattern. Then you estimate, you can project your take profit target using the length of, you use the length of your flagpole. This can be your area of your take profit. You project the length of your flagpole to be your estimated take profit region. So this is exactly where I will take my profit and give us a 1:2 risk to reward ratio. Remember to always monitor your trades and consider using a trading stop loss to lock in profits as price moves in your favor. This strategy allows you to protect your gains while giving room to the market to develop. Remember, no trading strategy is foolproof. Always use proper risk management techniques and consider using additional technical indicators to confirm your trading decisions. So by following this step-by-step strategy, you can effectively trade the downward flag pattern and potentially improve your success in the bearish market condition. However, always remember to practice on a demo account first before risking your money on a real life chart, because you cannot afford to risk your money with a strategy you haven't tested in the market. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and turn on the notification bell so that you will never miss out on more trading strategies. Thank you for watching, and I will see you in the next video. video.